All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Again, my apologies for my voice here. I'm not going to be on, too long here, but did want to jump on, show you a few things here with the market and a look at some of the economics that are out there in this market right now. I will not be after this video. I will not be here for the rest of the day. I am going to go take it a little easy. That said, any trade signals that come in, they will be traded and they will go out on the message feed and with normal alerts. I just won't be on video to do them. Now, to give you a little bit of insight as the potential for a trade here this afternoon, here are the bearish crossovers. There's nothing. It is completely empty on the bearish 3-7 crossovers. And on the upside crossovers, there's Bank of America. And that is the only upside crossover out there today. And I'll just tell you, there's zero chance of it triggering bullish here today. So as things sit, the chances of a new trade coming in are very, very low. But I do think we could see some market movement here into the close. I would not be surprised to see some selling pressure, start to come in, but we'll see kind of how that plays on out. Now, the challenge does have one position on the board, and that's gold with the GLD. It's up about 45 cents here, 50 cents. The stock is trading higher than where we entered, but we do have an option here that is trading lower than where we entered. So dollar 89 is the mark on it. So I'll fill that in. And we've seen this plenty. When we don't get movement, when we go 2-3 days without movement, there's the time decay element and the implied volatility element that comes into play. Time decay is the majority of the factor, here with it. But we have seen the implied volatility drop just a little bit on the GLD as well. So that is factoring in. Still in position here. We do have our auto exit red date coming in tomorrow at the close or in the afternoon session. So we'll see how it plays on out here. But we still have a pretty solid chart, pretty solid setup here. Be nice to see it just say, all right, let's go. But again, we'll see how that plays on out here. Jobs report tomorrow morning, will likely affect it as well. So there is that potential catalyst here for it. Okay, market here today. We saw overnight, futures improve on talk that, or comments out of China that, that trade talks were going well, and then what did we see at the open? Right at the open, we saw some heavy sell come in. Some very heavy sell, and it was very similar to what we saw at the close yesterday. And this is something pretty new in the markets. We have not been seeing a hefty sell pressure come in at the close or at the open, for the most part. Even on the gaps down, it's not like we see, big sell orders, flying in. We now have a close and open where we have seen that come into play, and that's typically more of a bearish type of scenario. We tend to see that happen in more bearish style markets. We have seen the metrics flip here this week, and so even though the market's bounced on back, we do see the metrics, remaining weak here. But you look at what has kind of popped, right? Semiconductors off. There's a trade deal. These are going to do well. They've come well off their highs here. You take a look at a Caterpillar. Well, this should do well if there's a trade deal. Well, money isn't going back into Caterpillar. Even with the positive, talk on this trade deal, and I made the comment in my note this morning that with what we're seeing with the economic data, with what we are seeing with the price action in the market's on a little bit of a slippery slope here. to where we could easily see a very hard, fast sell come into play if the dominoes don't fall perfectly for the Bulls. And I think they are, this is one of the few times over the course of this year where I think the Bulls, the onus is on the Bulls. And the Bears are still, they're not willing to step in. Though I do think, what we saw at the close yesterday, open today, is more fund manager dispersion, and then starting to do a little bit of year-end selling. But we have a market that continues to have that yeah but mentality. Oh well, this number's bad, yeah, but it'll be fine once we get a trade deal. And so if there's not a trade deal, the market is probably more more expecting of a deal now than what it has been, for any other time other than May, where this April, May, the market was kind of priced to, hey, we better have a deal, and that's just not the way this whole negotiation has gone. We continue to see the technical indicators in the market weaken, so we'll see how that all plays out. But the metrics themselves, we have seen a significant weakness in them here this week. All right. Now, a couple times I referred to some of the economics that are out there, and the economics in the market. And as you know, I'm an economics graduate. That was my field of study. I love economics. It's what got me into the markets. It's not the politics or the news or the headline writers and all that kind of stuff. It's the economics of it. And the economics are important when it comes to the market, but there are some times where the market is paying attention. There's sometimes where it's not. When it comes to the economics in the market, the economics drive the long-term bus, right? They drive the long-term market, while the news and the analysts and the opinions and all that, they can drive some of the short-term oscillations. Now, when we go look at what is happening economically out there in the global economy right now, it's a very interesting scenario, and it's one that I think has to be paid attention to. And so, let's go take a look at it here. I'm on a website called Trading Economics, and this is for as far as websites go for economic data, this one's phenomenal. This one is a great site to be able to come get the information, to be able to chart it, see it, just fantastic. But let's just come up here to indicators, and I'm going to go to countries. All right. Let's just look in the U.S., and we could do this same thing in any other country around the world. If we look at the Eurozone or China, the data is going to look a little bit different. But let's just go with the U.S. Take a look at some of the key pieces of economic data, right? And when we look at economic data, what are we looking for, right? We're looking for acceleration or deceleration, right? Not only on the upside, right? If we have a chart and we have this picture right here of the chart kind of going up like this is acceleration, right? Things are getting better at an improving rate. If we have a chart that looks like this down below, things are getting better but at a slower rate, right? This tends to be very bullish. The lower here tends to be rather bearish. Now, that's if the economic data is improving, right? If the economic data is not improving, then our graph, our chart, looks a little bit different. We can have economic data that's eroding at a faster rate, right? Or we can have economic data that continues to erode but at a slower rate. This one here on top, that's more of a bearish scenario. This one here on the bottom, even though the data is getting worse, is a little bit more of a bullish scenario, right? When it comes to economic data, it's a second derivative world. It's not, is the data going up or down? It's, what is the change of pace in that data, and that is what ultimately matters. So let's go take a look at a few key pieces of data. Let's start with the payrolls data, right? And this is for me. This to me is one of the least important pieces of data. But when it comes to the markets, when it comes to what everybody talks about, people just simply talk about it more than they talk about other things. So the non-farm payroll, and I'm going to come click here on 10 years. We can see what this looks like. All right. We have here over on our right side, the amount of jobs that are created month after month. And we can see what that looks like over the last 10 years. And this 200,000 mark has kind of been a nice little average, right? It's been a nice little average. And you can see that we dip below it and rip above it and drop and pop but it's been pretty consistent over time. But look over the last 6 months and what's happened to this piece of data, right? We went through at the beginning of the year, kind of, most months were above 200,000. But here in the second half of the year, most months have been below 200,000. In fact, this has been the longest period since the 2008, recession, that we have seen the jobs number below the median here, as consistent as what it has been here of late. We just see a weakening here. We simply see a weakening going on. And, in August it was 164,000. Or July it was 164,000. In August it was 130. In September 136. October 128. We'll get the November number tomorrow, right? And it's expected to be a 180, right? So even the the higher expectation is still set to be below 200. And if we look at what the ADP number was here this week, we could see this number miss and see this number continue to weaken. Now, we have not seen this number move below zero or into a job contraction scenario. So it's not like this is a bearish number in that regard, but it is a number that continues to weaken here over time. And the trend on this number continues to be falling off rather than improving. And I think that is something that is going to have to be watched for going into next year, and something where we could see some panic start to come in if we get a few more months of some pretty sour payroll data. Now, again, right now, the market's not paying attention to this. Market doesn't care about this, right? Market says, hey, if we have a trade deal with China, everything's going to be great, right? They had that blanket statement. So, yeah. But what happens? Eventually, the market will lose that blanket statement one way or the other. A trade deal will happen, or a trade deal won't happen. But we will have this kind of pushback to the data. And when we push back to the data, is that going to be bullish? Is that going to be bearish? Well, if it's just the jobs data, a little bit more bearish, but not incredibly bearish, right? Let's go to business confidence, right? Business confidence. This is a big piece of data, and it is a piece of data that is in the PMI numbers. And it's a survey piece of data. And if we come in, do the same thing, click on 10 years, take a look at what business confidence has been doing. Now, business confidence, and one of the things I like about the number is it tends to be a lot more cyclical than other numbers, meaning, it has higher highs and lower lows, and, it can really, ebb and flow in a big way. But we don't see very often where the business confidence is at a 10-year low when stocks are at all-time highs. This is a really interesting number, and one that I think is, a warning sign out there for the market, and one where, you think about those that are in charge and making big business decisions. they continue to grow more pessimistic on things. And in that type of situation, what do they tend to do? They tend to stop spending. They tend to stop hiring. They tend to just generally cut on back. We've seen that in some industries that have been affected by the trade war. In others, not so much. But this is a number that is the lowest in 10 years, and a number where, the last time we saw it dip down to this level was 2008, right ahead of the Lehman crash. And then when we saw that before was the dot-com recession. So it's weakening to a point where on a historical basis, there's some red lights, going on here with this number. All right. So anyway, that's business confidence. If we look at just the manufacturing PMI number, right, you'll notice that it's had a dip here throughout the course of this year. It has been popping on up a little bit, right? It's kind of that green shoots mentality. But the services number, the non-manufacturing PMI number, you can see that over the last half of this year has just continued to fall. Now, what is this? This isn't this type of curve where it's, where it's getting worse where it's, getting better at an accelerated rate or getting worse at a slower rate. This is still growing data, but it's growing at a lower and lower rate. So the curve, if we were to plot it correctly, kind of looks like this right up here. That tends to be a little bit more of a bearish scenario. We do see that in the services number, out there. So some of the bigger numbers, we're not seeing really ideal bullish situations, coming into them. If we come into something like consumer confidence, there's nothing there's nothing here for the bears. There's nothing too much here for the bulls. It just continues to be solid, the way it has over the last 5 years, right? And a lot of the other economic data that we could go through, that's what we're going to see, and that's going to be the majority here. Is just seeing, hey, things are as they've been. But when we look at some of those kind of more front end pieces of data, they are starting to show a little bit of weakness in them. Now, we're in this idea of a trade war. What about imports and exports? Well, take a look at imports in the U.S. They're still near record highs, right? The U.S. is importing a ton, right? What about exports? Have they stopped exporting? Has the U.S. stopped exporting? No. The exports are still phenomenal. So we're not seeing, imports and exports on aggregate be affected, to a tremendous degree there. And so it's just one where, okay. But then the last one I want to take a look at with you is new orders, right? New orders, this tends to be a big leader when it comes to the economy. And, when we saw the Fed cutting and the Fed starting to normalize the balance sheet and raise interest rates, and we saw kind of the market or the economy go into a mini recession. We saw earnings recession. We didn't see an economic recession, but we did see an earnings recession in corporate profits. We saw the new orders data, continue to fall and drop. Well, the new orders data this year, it's been falling, but not at any real heavy pace, but we've stopped seeing it improve. And I think this is a big piece of data going into next year, that, if we see the new orders data start to improve again, market has, a lot more new highs to make. But if we do see this new orders data really start to tail off a little bit more, we're in for at least the thought of a corporate recession or an earnings recession. Even if we don't have a traditional GDP type of recession. So when I look at the economic data on aggregate, right, most of the data, just the same old. And Yep, just the normal growth. The growth continues to be sluggish, but in some of the key areas, the growth is starting to, show signs that we don't see very often and that we normally will see ahead of major recessions. To me, it's a warning sign. It's a warning sign, and that's it. It's a warning sign. If you start to see things confirmed, then hey, sure. But that warning sign is out there, one that I do think needs to be heeded and needs to be understood. From a trader and investor standpoint, and I suspect that one of the things we will see going into 2020 is a much more volatile market. Because when we start to see the data do this type of thing, we get more volatile conditions, bigger rips, bigger dips, and those types of things. And I'm on record of already saying I expect that to come in here in December. We haven't had too much of it. I guess a little bit, this week, but we haven't had the market moving 1%. So when we start moving more than 1%, I'm willing to go. Okay, maybe we're talking about a little more volatility. But I do think 2020 is setting up for some increased volatility, especially around the U.S. election, around the way the economic data is going, and around the trade war, and ultimately how that continues to unfold. All right. Alrighty. Any questions on that? Please let us know. Support at Trader Minute, and I can take a look at that. But hopefully that helps you out. Just kind of understanding, what the environment is here overall. Again, I'm still in GLD. I'll probably hold this into the close. I will not be back on video here today, but any trades that need to happen will go out via alerts here this afternoon at the normal time. But just looking at the scans, there's not a lot, and it's one where I'd be very surprised if we do see an alert come in. In fact, Bank of America has already gone off the bullish scan, and Conoco's emerged on the bearish one. So, Conoco had an upside crossover yesterday. Today having a downside crossover. Shocker. We've seen this quite a bit with many stocks here of late. I would not be surprised to see a continuance there. All right. Thanks for hopping on. Have yourselves a fantastic one, and we'll talk to you tomorrow. Take care.